A financial crisis on Wall Street just around the corner. The biggest bubble in human history is about to burst, according to Universa's Mark Spitzangle, who has made billions from previous crashes, sees a huge time bomb about to explode in the economic world. When Mark Spitzangle talks, Wall Street listens. The first reason is that since he founded the tail risk hedge fund Universa Investments in 2008, he has recorded spectacular returns, such as making a profit of $1 billion in a single day, as described by a Wall Street Journal article. Tail risk is a form of portfolio risk that occurs when the probability that an investment will move more than 3 standard deviations from the mean is greater than that indicated by a normal distribution. Tail risks involve events that have a low probability of occurring and appear at either end of the curve of a normal distribution, as reported by the Economic Post. And this leads to the second reason the market pays attention to what it says, whether he says. Spitzangle has consistently not relied on any kind of short-term view to turn a profit. The complex strategy. The enigmatic quant, a protege of Black Swan author Nassim Nicholas Taleb, loses money almost every day through a complex strategy that pays off only in highly volatile periods. Major crashes such as the 2008 financial crisis, the 2015 flash crisis, and the pandemic market crash of 2020 were enough for an investor with a small position in the fund to outperform an investor with classic positions 90-40 ratio in stocks and bonds. His prediction is quite ominous as he sees a major sell-off in the stock market, with stocks potentially losing more than half their value. However, predicting even roughly when the market will crash is much more difficult than hedging a portfolio against a crash, many would say impossible, in the same way that so many fund managers and strategic advisors always sound optimistic. The scaremongering sounds like a clever marketing exercise for someone hedging against tail risk. He said, I think we're on our way to something really, really bad to be expected to say that. Spitzer joked in an interview this week. He estimates that the rally will continue for months and become even more intense. This is because the market is a Goldilocks phase as inflation declines and Fed easing fuels bets for further gains, but interest rate cuts are often the kickstart for major market reversals, he points out. Another contrarian sign is that some in the investment community remain cautious. He says, you don't feel like a fool making a fall argument, he says. Memories from the dot-com boom era. In May, Morgan Stanley's chief strategist Mike Wilson turned bull shortly after losing his seat on the firm's Global Investment Committee, and just recently JP Morgan's Marko Kolanovic, who stuck to his pessimistic guns during the AI rally, lost his job. Fund managers who have not jumped on the AI bandwagon, holding stocks like Nvidia, are licking their wounds. These stories echo the dot-com boom era. In late 1999, months before the S&P 500 peak, Merrill Lynch's once bearish strategist Charles Claw left the firm. P.S. By the term bull, we mean that the one who sees the market upwards, and by the term bear, we mean the one who sees the market downwards. A huge time bomb ready to explode. Spitzangle predicts an even worse turmoil than a quarter century ago because the excesses are more extreme, the biggest bubble in human history. High public debt and valuations make a Washington-led bailout more difficult. He believes that today's benign slowdown in inflation has gone too far and says that the U.S. economy will go into a recession. The ominous language he uses to describe the macroeconomic situation is mega tinderbox time bomb. His analogy is more subtle than it sounds. Governments were so active in the state risk of any fire in the economy, so the debt and other hidden risks have created the ingredients for a serious fire. The Cassandras are terrible investors, he says. How should mere mortals without access to tail hedging react to his prediction? Probably by doing nothing, he says. The Cassandras are terrible investors. Staying passively invested in stocks is the best long-term strategy, he says. The core purpose of the protection Universa sells is to make professional fund managers feel comfortable taking that risk and then provide them with additional cash when opportunities arise. Retail investors won't have clients who will pull their money away in a bad year. Those who can put up with steady contributions, taking that risk and then providing them with additional cash. Retail investors won't have clients who will pull their money away in a bad year. Those who can put up with steady contributions to an index fund while reading scary headlines will do just fine. In the long run, they will do better than wealthy investors who buy increasingly popular structured products designed to smooth out market volatility. Why does he believe this? One reason is that their building blocks, such as put spread collars, include the derivatives that Universa buys for its fund. The long-term resistance it creates to buyer returns is its strength. We like guys with put spread collars, he says. It was never a good trade. This is from Pentapostagma. Please leave your comments. Thank you for your support. Finally, support my Patreon account. The daily posts are 5 videos daily, and they are totally different from what I have on my YouTube channel. Thank you so much for your support and that you find all my content so interesting. You'll find the Patreon account details in the description box below.